Now, before we jump into the refined products, again, we'd like to remind everyone if you could subscribe, like, share. Again, we'd like to keep this free, and the more support we get, the better. So now just jumping into the U.S. product supplied. Again, we like to look at that average, and you can see that, again, we had a big drop down, then we had a fairly strong spike to the upside, which keeps the average fairly flat, which is something that we've talked about previously. We see that kind of continuing. And as you look at 2008, 2009, 2017, we typically start to see some decline, which, it depends on when we see it. October is going to be was fairly flat once we average it out. November, just based on what we're seeing on cases and some hospitalizations. Again, it's more behavioral studies and just people are just going to adjust their behaviors. Not that there's going to be this huge lockdown, there's going to be these problems. It's just people are going to do less just to avoid some exposures, which again is just going to kind of keep us to the side. And it'll be kind of noisy up and down, but if you look at the 4-year average, it remains fairly flat and consistent over the last few weeks, which just based on what we're seeing, there's nothing to really tell us that there's going to be any deviation up or down. It's just going to kind of be sideways. The question next comes to, well, what does heating demand look like? Are degree days going up, going down? So far, it's a fairly warm November, but again, trying to predict weather's just as much fun as trying to predict exports and when they get filed. So we'll see. Distillate had a nice draw. You can't take that away. We had a draw of about 4.5 million barrels across the board. Biggest drivers being PADD 3 with a draw of about 3 million barrels. Again, that's something that should be fairly consistent as we go forward. And it's twofold if you want to think about where this is going. So just to touch on the actual storage, you can see it's had a very strong drop-off, which is great to see in terms of some normalization. The question is going to be what happens next. And when we look at what's happening, we think that the draws will continue because you are getting jet fuel kind of pulled, or kerosene pulled out of the disti pool a bit, which is a benefit. And you're also getting some recracking still into gasoline, which is a little bit of a benefit as well. Again, if you look at production remains depressed. Even though we had an increase in refinery utilization rates, you still had guys focusing more on gasoline, more on other to avoid some of this distillate cut, just because, again, we still remain elevated, and the idea is getting as close as we can to that 5-year average. A colder winter would help that along. The question is always going to be, what does that look like? But overall, strong draw, strong benefits. The problem will be exports is something that we see still remaining, is still going to struggle. But as we go through in a bit more detail, trucking remains stable, rail remains strong, and that will help kind of pull some of this through overall. When we look at the over the last 30 years, we've been saying that it was just gonna kind of hang around that average and probably drift a little bit higher. Here it is. Obviously, it's stronger than what we were expecting, but again, it was still a strong bounce. Something where, again, when we look at averaging out, it will fall back to that average, but it still will remain strong, will remain above the 30-year, and we will continue to see this remain robust, especially as we see trucking remaining stable to strong, rail remaining fairly strong. It's just the exports is going to be the biggest issue as we look towards essentially going into November and beyond. Trucking, we always need to look at this. So our confidence range was 95 to 105. We're at 97.94. So again, right within that component. We don't see it, again, going much further down below that or above that. It's going to remain within this fairly tight range as demand for trucking remains robust. We still have guys preparing for Christmas, and we'll talk about Christmas shopping and expectations in the economy show. They have obviously fallen back, but again, we still will have a holiday season, and it still remains cost effective when you look at just at the bottom now. When we start to look at where those rates are normalizing, but they're normalizing at a higher level, which is again positive because spot pricing has pulled higher, and we've had contract pricing really lagging, and now we're starting to see those more long-term contracts starting to price in some of these higher levels, which will be overall a benefit for the industry. Truck availability is kind of flattened out. We've had a little bit more truck availability, and then load availability starting to kind of merge a little bit. And again, it's just because we're starting to see some normalization of inventories, trucking, but it still remains robust, and it will be a bright spot for diesel demand as we go through even the remainder of the year. This is not something that we think shakes up. Even if we do get a big resurgence of COVID, you can see that the resurgence of COVID really was a huge driver as guys try to re-energize their supply chains, and we just don't see that stopping. So even if we do get lockdowns and some other issues within the U.S., trucking will remain the answer. Rail is another big one. Again, we've talked about grains. Grains is going to be very strong. We were going to do a special segment on just grain exports from the U.S., Chinese demand, global demand, as we look at the international market. That will remain very strong, and it'll be a bright spot as we see, like now with even grains year to date. We're now above 2019. Again, that's going to continue. We're going to continue to outshine 2019 as those exports continue. Total car loads still remain down versus 2019, down about 14.7%. There's not much that we see changing that, just as we have some slowdowns in non-metallics, some of these others, but the petroleum and petroleum products will be one to watch. If we do get a bigger increase in Canadian flow, there will be additional demand for tanker cars, so that's one that can see some bright spots as we go forward. Intermodal remains strong. It's actually above where it was last week. That's one where, again, as we said, that we thought we were going to see a spike. That spike will remain through the next 2 weeks or so, and then it'll start to roll off as some of the bigger demands start to slow down. But when we look at intermodal on an aggregate, including grains, that's one where we think there's going to be some support. Total traffic up 1.9%. Again, that's one that we think is going to be fairly stable week over week when we compare it to 2019. Which will be a little bit of a bright spot for the pull through, but the intermodal is the one that we think is going to start to roll over. And again, it's still year to date down versus last year, but again, it's going to start to we'll start to see that normalize, and we should see intermodal kind of pull in pretty close to where 2019 was. Which again, most of this demand right here is going to be strong for diesel, just because they are diesel engines, and that's something where the grains really won't stop. And as you can see just from the bar chart, how aggressive those grains are, which is good to see. And it's hopefully it's benefiting our farmers as we all know that they've been struggling through from the start of the trade war to now, but that's something that we'll talk about in the economy show. Looking at gasoline, wasn't as strong as expected, but it was still a draw. It was still 890,000 barrels. The biggest reduction was PADD 3. Again, which was down about 1.7 million barrels, which again is just some of that normalization, some of those benefits overall. Imports came in a little bit. We will start to see those increase as we go into November, as the arbitrage was open and the deliveries start to increase. Production was up, as we talked about with the distillate side. Production of gasoline has been more of a focal point, and you can kind of see it's starting to flatten out, and it's at that all-time high level. But the problem with gasoline, and we'll show this in the next chart, it's a little bit better to look at it from a 5-year average, just because gasoline demand has seen incremental growth essentially every year as more cars, more storage has been built. So to kind of pull it into perspective, it's important to look at where things sit. And you can see the strong decline in storage, but now we're starting to level off. And typically on a 5-year average, we normally see an additional decline as people get more active in driving. And instead of following that decline, we think it's going to be a bit more sideways, more because, again, distillate is focus. The focus is more on gasoline storage, gasoline production. We do have more imports coming, so this will keep gasoline fairly elevated versus the historical average as we go through the remainder of the year. And now, as we turn to total products, again, we're going to kind of bump along to sideways. Typically, if you just look at the bottom of the range on that 5-year average, you can see the bottom of the cloud. We normally have a bump here, and then we kind of go sideways. Again, just based on what we're seeing, there's nothing to say any other different, that we're just going to kind of hang sideways on that demand side, especially as we have some pull through for diesel, some benefit from gasoline. But again, gasoline is going to be a little lumpy, as we've seen continued slowdowns in demand looking at Gas Buddy data and some of the others. Now, just to look at crack spreads, again, 321 is a calculated spread, so it's more of a financial index. If this segment would be very long if we started breaking out some of the different ones. We just wanted to show that typically there is an increase in crack spreads, specifically here, and based on just what we're seeing in terms of some of the pressures on the gasoline crack, diesel crack. I should say gas oil at this point. There's not much to say that there's going to be any elevation. Obviously, falling crude prices does help, but some of that's offsetting is some of the slowdowns in demand, both Europe and in Asia, which we'll talk about in exports, or I should say the third segment, which is going to kind of keep us within this fairly tight level. Looking at just overall movement and looking at the Google data overall, you can see it's a slight trend to the downside, but not much. I think, as we've talked about, people have already kind of factored in some of those increases in cases, and you're just seeing people just adjust where no one's really rushing back, but no one's really doing much of anything at this point, and everyone's kind of sitting with their hands tied, kind of waiting to see how this all shakes out as we go into winter. Now, looking at Apple mobility data, you can see that there has been registered a big drop week over week. If you go back to where we sat before, the biggest drops again have been Italy, UK, and Germany, and that's why it's not surprising. Just because we've had curfews already, we've had increasing cases, increasing hospitalizations, which has really pulled back a lot of activity within Europe itself. The US continues to drop, but again, it's dropping at a slower pace. It's just people are just waiting to see how this all shakes out as we look at mobility trends. And it's one where we're not going to see that precipitous drop as we saw in March, but we will continue to see this drift lower as the lockdowns like Germany. Merkel got an agreement for a partial lockdown. France could announce a full month-long lockdown as early as Thursday, so we'll start to see some of those movements. UK already had curfews. We've seen that already impact in the pub data, and we'll talk about an open table, drifting lower, which again is just going to impact total mobility. Looking at the weekly gasoline data, this is, again, looking at Gas Buddy. There was a small decline versus the prior week of about 47 basis points. And just as a reminder, it's one where we've seen 3 weeks of straight declines, but the declines have been measured in basis points, in terms of 47 basis points, 54 basis points. So again, there's some stability where we are, which is why when we talk about what does the U.S. look like, at the current levels, we think it just remains sideways. We think there's a little drift lower, but again, we're not moving down 5%. It's something where we'll sit within 25 to 50 basis points going forward. This is just looking at reported infections, looking at that 7-day trend, just because we wanted to look at kind of where things are trending. We have taken out some of the highs in July, but this is something that is more, will just spark people to do a little bit less. But when we look at lockdowns and something, we have to look at hospital utilization, ICUs, infrastructure. I still remain fairly confident that we won't have to see any lockdowns, just because they didn't really work before in terms of flattening the curve, and we flattened the curve, but now we're seeing more infections, but a little less severe, which is a positive in terms of seeing some additional issues. 7-year trend remains to the upside. There's nothing to show that we're going to change that narrative. The question is going to be what happens over the next few days, and as we go into an election that is going to be an interesting one overall. Hospitalizations, quick moment on this. You can see that they are rising, especially against the 7-day percent change. Again, percent change can also be a bit misleading, because if you go from 1 to 2, obviously that's a large percentage. So some of this is a bit, I don't mean it to be shocking, because you have to kind of drill down a little bit. The Midwest has seen a little bit more of an increase on a numbers level, on holistically. And the reason why that's a little concerning is because the Midwest actually accounts for a large number of our miles driven. So that's something to watch as we start to see miles driven fall under pressure. The Northeast is starting to pick up in terms of hospitalizations. Again, it is fall into winter, not surprising. California is the positive. The California is also a huge driving state. So to see them starting to normalize, hospitalizations remaining low, it's obviously very positive. And then the question is going to be, where do we sit going forward? But this is going to be the one to watch if we want to think about lockdowns, curfews, and any type of mandated problems will be here. But we do not have the buy-in for lockdowns. I can't stress that enough. So even if we get them, I don't think that they'd stick. People would still do a little less. But again, people need money. The economy's been struggling. So it's going to be hard to see that really impact unless we get a real scare like we did in New York in the beginning of this, when you had hospitals going from 20 patients to 22 floors filled with patients. So again, obviously that we have to weigh all the different options. Jet fuel had a small draw of 210,000 barrels. Again, we've just been saying that demand is going to go sideways. We actually think that at this point, demand is going to drift down to the lower end of the range, just based on what we're seeing with new flights and some of the pressures going forward as we go into the fall and winter season. Looking at overall TSA passengers, we remain pretty confident in our call about 550 to 850 overall. We were initially saying 750, but again, we've had a little bit of a trend higher, which is a positive for total demand. But it's really being driven by more seats being consumed in less flights. So even though it's positive to see there's more weight, which means more jet fuel burning, we're not seeing a huge increase in new flights being brought online, which again will, even though this can trend a little bit higher, it doesn't mean we're going to get a bigger increase in total jet fuel demand, which we can see here, where we have departures decreasing. U.S., we saw a decline, 117.94. China, 139, as we get normalization from, because they also had a spike in cases. They've also been, they've seen their vacations end. And Germany and Europe continue to see declines in total departures, which is going to increase week over week as the partial lockdowns start to intensify. And we just think that we're going to get fewer departures, which will impact that total jet fuel demand. Again, we've normalized a bit on storage, which means that we won't see this rushing into the distillate cut, which will help distillate draws remain fairly strong. But this is just going to be something to watch as we look going forward, as there's lockdowns that are set to span anywhere from 2 weeks to a month. Looking at overall congestion time, just picking two areas, London, Rome, as we showed last week, we saw a big negative move, and London, Rome continued their downward trajectory in terms of just less people doing less stuff, as we have an increase in cases, increase in people doing just pressure on overall demand. New York remains fairly consistent with another small increase. Again, just based on what we're seeing with new cases in New York, I would expect this to kind of flatten out. Not really drop, but just kind of to hold this line here in terms of people getting a bit more comfortable with the safety measures that are being taken, which will keep people active. But it's not something that I expect to see a continuing growth, as London and Rome, I think, will continue to the downside overall. And we're starting to see that in open table global data as the seating continues to trend to the downside, which is something that we talked about as we saw spurts of fear with curfews and additional lockdowns. So this is one that we think the average is going to trend to the downside with lower lows, lower highs, just as things start to slow down on an aggregate. And then when we look at where is that aggregate, you can see Germany has had a very strong slowdown. The UK, something similar. The US remains fairly stable right now. It's one where we think will trend a little bit to the downside, with that average getting closer to 50 to 55%. And we won't really see those 43, 33% even in the weekends, just as people start to slow down a bit. Ireland, Germany, UK is just showing you just the adjustments that we're seeing overall in Europe, which is just going to be additional pressure for refined product consumption. We've already had announcements of rollbacks in refinery rates, which will put more crude on the water, but will also just based on this decline in demand, will put more product in storage, which is something that we'll talk about. But the one positive that we continue to see is MTA entries continue to trend higher in New York. And just based on some of the increase in cases, again, it's just not that it's going to come down, it's just going to remain kind of flat to sideways on total entries. And it was something that we're seeing happen in multiple different areas. And again, just to reiterate, it's just pressure on demand overall. It's not that we're going to go down to those marked lows. It's just that we're kind of hanging to the sideways, which as long as refiners can stay here, the question is now if OPEC protects pricing. Well, we've already seen refiners can't make margins. Demand remains a problem. So they're cutting runs, which is going to just put additional pressure on oil demand, which, as we talk about in the next segment, is just going to leave more on floating storage, more on onshore storage. So we may see some additional draws in refined products, hopeful, but then that would mean that there's just less oil being consumed. So even though there's less oil in transit, there's less oil being consumed. So again, they kind of net out and you see additional builds overall. But we'll go through that in a bit more detail in segment 3.